Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 4. This is Section C2. This is a remembering and understanding topic. Identify the factors that an accountant should consider when reporting on an engagement to compile an entity's financial statements. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you watch that, you're going to want to learn more, so make sure you also check out becoming a Superfast CPA Pro member. Pro members get access to the full 10-question versions of these 5-question YouTube videos. So again, we're only going over 5 questions today, but Superfast CPA Pro members will get access to the full 10-question versions so that they can get a little bit more help and a little bit more understanding. So if you like this, check that out. Now, with all that, let's dive straight into the questions. All right, here we are at question 1. Which of the following best describes the level of assurance provided in a compilation engagement performed under SARS? So in the previous video, we talked about preparation engagements, which are also under SARS, but this is something different, a compilation engagement. So let's dive into the options. Option A, limited assurance that the financial statements are free from material misstatement. Option B, reasonable assurance that the financial statements are fairly presented. Option C, no assurance is provided on the financial statements. Or option D, assurance is only provided if the accountant has prior experience in the client's industry. So again, what level of assurance is there for a compilation engagement? If you know, that's great. If not, though, that's okay. We are going to use this question and this answer to start learning. So let's dive into the explanation. All right, here we are. The answer is C, no assurance is provided on the financial statement. So no assurance is provided. And let's first learn a little bit about what a compilation engagement is, just in case you don't know what that is. And then we'll kind of talk about some of the rules in the following paragraph. So first, a compilation engagement is when an accountant helps put together a company's financial statements using information from management, but doesn't check the numbers or give any opinion on whether they're right. It's just organizing the information, no audit, no review, and no assurance. So a preparation engagement, they're preparing the financial statements, but a compilation engagement, all they're doing is helping the management to present. They're just putting the financial statements together. The accountant's role is limited to assisting management in presenting financial information in the form of financial statements. Again, I just said that. The accountant does not audit or review the financials and does not express any opinion or conclusion about them. No testing of internal controls or verification of data is performed, and the accountant is not required to make inquiries or perform procedures to corroborate the information provided. However, the accountant must read the compiled financial statements and determine whether they appear appropriate in form and free from obvious material misstatements. So they at least have to read through it and just say, yeah, this looks roughly correct, but again, they're not required to do very much more than that. Also, even if the accountant has no prior experience in the client's industry, they can still accept the engagement, as long as they obtain an adequate understanding of the industry's accounting principles and practices. So we learned quite a bit there in just that one explanation. Again, no assurance, and they're just pretty much putting the financial statements together. They're not required to, do any procedures or anything like that. All they have to do is put it together. They're supposed to read through it and make sure that it looks okay. But other than that, that's pretty much what you do in a compilation engagement. Now with that, let's go to the next question. All right, here we are at question 2. Which of the following statements is required to be included in a standard compilation report under SARS? So now we're learning about what is in the statement, what is in the report. Let's go through the options. Option A, management is responsible for the preparation and fair presentation of the financial statements. Option B, the financial statements have been prepared in accordance with the accountant's preferred reporting framework. Option C, the accountant evaluated the effectiveness of internal controls during the compilation engagement. Or option D, the accountant has reviewed the financial statements and believes they are free from material misstatement. So again, what is something that is required to be in this standard compilation report? What are they supposed to say? Now, if you know, that's great. If not, though, that's okay. We are going to use the explanation to continue learning. So let's dive in. All right, here we are at the answer. A, management is responsible for the preparation and fair presentation of the financial statements. So this is a statement that has to be in the report. So let's go through this. A standard compilation report under SARS, and remember we learned what that means in the previous video. If you don't remember what that is, I would recommend, going and watching that. Must clearly state that management is responsible for the preparation and fair presentation of the financial statements. It must also state that the accountant performed the engagement in accordance with SARS and that the accountant did not audit or review the financial statements and does not express an opinion, conclusion, or any assurance. The report must be dated as of the date the compilation is completed, and while a standard report assumes substantially all GAAP disclosures are included, this must be modified if disclosures are omitted. Internal control evaluation is not part of a compilation, and the accountant does not base the work on their own preferred framework. So we learned, again, a lot about what is supposed to be in this report there. We learned that they have to clearly state that management was responsible for the fair presentation. We learned that the accountant has to state that they did not audit or review the financial statements, that they're not going to give an opinion. They have to date it on as of the date the compilation is completed. And they are, typically assuming that all the GAAP disclosures are included, whereas they would modify it if that actually is omitted. But you can kind of just assume that all GAAP disclosures are there. It's kind of implied there. Now with that, we learned a little bit more about compilation engagements. Now let's go to the next question. All right, here we are at question 3. When compiling a financial projection under SARS, which of the following statements must be included in the accountant's compilation report? So let's go through this. Option A, the assumptions used in the projections are reasonable and based on current market conditions. Option B, the accountant has no responsibility to evaluate the assumptions or projections for reasonableness. Option C, the accountant provides limited assurance that the projection will achieve the forecasted results. Or option D, there will usually be differences between projected and actual results because events do not always occur as expected. So again, this is kind of building off the previous question. What's some more things that have to be in this compilation report, especially when it comes to a projection? Now, if you know, that's great. If not, though, that's okay. We are going to dive into the explanation again. All right, here we are. The answer is D. There will usually be differences between projected and actual results because events do not always occur as expected. So they have to state this explicitly in a compilation of a financial projection. So let's go through this. When compiling a financial projection, the accountant's report must include a statement that projected results are not expected to match actual results because events and circumstances frequently differ from expectations. This statement is essential to prevent users from misinterpreting the projection as a guarantee. The accountant does not provide assurance, does not express an opinion, and does not evaluate the reasonableness of the underlying assumptions. These remain the responsibility of management. However, the report must also contain a paragraph discussing the limitations on the usefulness of the projection, and that has to do with, the differences that are going to be there between the projection and the actual results. Basically, the accountant is just straight up saying, this is a projection, but there is no guarantee that this projection will be the same as the actual results. Now with that, let's go to the next question. All right, here we are at question 4, and something I always like to point out when it is an option is you want to read the last part of the question first, the last sentence. In this situation, it's not going to be extremely helpful, but it is a great habit to be in for test day because you have no idea what you're going to be seeing in the questions. And reading the last sentence first very frequently will give you context for what is going on in the question so that you can be looking for what you need to know as you read through the rest of the question. So we're going to practice that here. And I wanted to kind of do the last 2 sentences here. Management refuses to revise the statements. What should the accountant do? Okay, so we immediately know that management is refusing to revise something. So that's not good. Let's go up to the top. An accountant compiling financial statements under GAAP notices a departure from the applicable financial reporting framework. Again, management refuses to revise the statements. What should the accountant do? So let's go through the options. Option A, withdraw from the engagement immediately without explanation. Option B, modify the compilation report to describe the departure and its effects, or withdraw if modification is not adequate. Option C, disclose the issue in a footnote and proceed with issuing the standard compilation report. Or option D, issue the report unchanged since no assurance is provided in a compilation report. So what is the accountant supposed to do if management refuses to revise the statements based on the accountant kind of pointing out, hey, this is a departure from GAAP? So pause the video, think about this, base it on what we've learned so far. If you don't know, that's okay, but go ahead and try. And when you're ready, come back, we'll look at the answer together. All right, here we are at the answer B, modify the compilation report to describe the departure and its effects, or withdraw if modification is not adequate. So this is what they're supposed to do. Let's go through the explanation. When an accountant becomes aware of a departure from GAAP during a compilation engagement, they should first request that management revise the financial statements. So that's the first thing they're going to do. They're going to say, hey, this is a departure from GAAP. You should probably revise the statements. If management refuses, the accountant must modify the compilation report to include a separate paragraph that describes the nature of the departure and, if possible, its effects on the financial statements. If modification is not sufficient to prevent the financials from being misleading, so if it's just way too material, it's not going to help to have that small modification, the accountant must withdraw from the engagement and perform no further services related to the financial statements. This ensures users are not misled despite the non-assurance nature of the engagement. So even though there's no assurance provided, they're still not trying to mislead users. So if management is refusing to revise things and a modification won't be enough, then the accountant should withdraw. Now with that, let's go to the next question. All right, here we are at question 5. Which of the following is true regarding independence in a compilation engagement under SARS? So let's go through the options. Option A, independence is required and must be documented in the accountant's report. Option B, independence is not required, but the lack of independence must be disclosed in the compilation report. Option C, independence is not required and does not need to be disclosed. Or option D, independence is required only if the compiled financial statements are intended for third-party use. So what's true as far as independence when it comes to a compilation engagement? We learned a lot about independence when I very first started making videos for the audit exam, but is it different for compilation reports? If you know, that's great. If not though, that's okay. We're going to go to the answer to learn a little bit more. All right, here we are. The answer is B. Independence is not required, but the lack of independence must be disclosed in the compilation report. So that's pretty self-explanatory. Let's just go to the explanation. Unlike audits and reviews, independence is not required in a compilation engagement. However, if the accountant is not independent, they must disclose that lack of independence in the compilation report. If the accountant is independent, no statement is needed. If the accountant fails to disclose the lack of independence, the report would be considered misleading, even though no assurance is provided. The accountant must also comply with all other SARS requirements, including obtaining an engagement letter and reading the compiled financial statements for obvious errors. And we already talked about reading the compiled financial statements. And remember, they do also have to have an engagement letter. In fact, I'm pretty sure you have to have an engagement letter for pretty much every service that an accountant/auditor is going to perform, because you have to be very clear with each other what is going to happen and what the procedures are that are needing to happen. So we learned a little bit more about compilation engagements there, and kind of just an example of this. If an accountant, for example, has an interest in the organization that they're compiling financial statements for, that would be something that would need to be disclosed, because that's making them not independent. But because it's a compilation engagement, as long as they disclose that, they can still do the compilation engagement. Now with that, we learned a lot in the first 5 questions. Before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is, as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about the rules for compilation engagements. They're trying to teach you about independence or whatever the case is. Again, you notice these things popping up in multiple questions. So you take a moment and you write these out in your own words as, again, the pillar topics, the key points. And as you do this each day, you are building your own personal repository of the most important things you learned from the questions day by day in your own words, so that you are ready for the exam when you come to exam day. Now with that, let's go ahead and go to the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, let's talk about the fact that there's no assurance and that it has a limited scope. In a compilation, the accountant provides no assurance and does not verify or inquire about the financial data, but must read the statements for obvious misstatements and understand the engagement before accepting it. So even though they are not going to provide any assurance, and they're not required to inquire about anything, they should still read through them and check for obvious errors, and they should still make sure that they understand the stuff that they're about to compile before accepting the engagement. Now let's talk about the required report elements. The compilation report must state that the engagement was performed in accordance with SARS, that management is responsible, and that the accountant does not audit, review, or provide assurance. The report date is the date of completion, and a standard report implies full GAAP disclosures. Again, this is implied. You can just assume that it has full GAAP disclosures unless the accountant decides to point out a departure from GAAP. Now let's talk about projections and limitations. When compiling projected financial statements, the accountant must include a limitation paragraph and a statement that actual results will differ. No evaluation of assumptions is required and no assurance is provided. And we've said that multiple times. Now let's talk about responding to misstatements or GAAP departures. If the financial statements appear materially misstated, the accountant must request corrections or withdraw. GAAP departures require a modification paragraph or withdrawal if modification is not enough. And again, notice how it says there that things appear to be materially misstated. Again, the accountant is not doing much more other than just reading through and making sure that there's no obvious errors. They're not doing anything super deep like you would in an audit. However, if things appear misstated, if there's something that's obviously off, that's when they would ask for correction or withdraw. And then finally, let's talk about the final thing, documentation and independence. Independence is not required, but a lack of independence must be disclosed. Required documentation includes the engagement letter, significant issues, and any fraud-related communications that came to the accountant's attention. So these are all the things that we learned throughout this video. Those are the pillar topics. And remember, we're only doing 5 questions for this video, the YouTube video, but SuperFast CPA Pro members are going to get access to the full 10-question version of the video when we post it in the member forum. I'm about to finish that after I finish this video. So if you like this and you like our other videos, make sure you check out becoming a SuperFast CPA Pro member, because you'll get access to a lot of great stuff, again, including the full versions of the videos. And the best way to become a SuperFast CPA Pro member and to learn about it is to go to SuperfastCPA.com and sign up for our free 1-hour webinar training. You'll just want to click on, yes, I want to pass faster, or something kind of along those lines. That's where you want to go to check out the webinar. It's only an hour long, it's free, and we will teach you the key ingredients to passing the CPA exam. And after that, you'll have a much better path to knowing more about and to becoming a SuperFast CPA Pro member. So check out the webinar, check out becoming a pro member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.